Hey guys, so in today's video, we are going to be going over the pros and cons of a 3.5% down payment FHA loan when buying your first house. And if you're not familiar with the process, basically lenders and banks will allow for first-time homebuyers to purchase a property while only putting down about 3.5% as a down payment towards the property, as opposed to the commonly known 20% that you may typically have to put down. Now, lenders put this program in place and are willing to issue loans to people for a very small percentage of a down payment in order to incentivize more people to buy homes, take out mortgages, and essentially keep the real estate market moving. You'll find people putting down all sorts of down payments when buying a property, and I recently learned that the average home buyer is actually only putting down about 5% as a down payment in most cases. But is this really smart? Are these people stretching themselves and making themselves house poor? We're going to be going over all of this and more in this video. Before I get started, don't forget to hit the subscribe button down below and comment any video ideas you have in the comment section. So let's get into it. So the first thing I want to say is that there really is no black and white, wrong or right answer to this question, because everybody's needs and goals as it pertains to real estate is different. Some people have the desire to simply own their own property for the pride of ownership, and aren't as worried about maximizing every dollar and making it the smartest financial purchase of their life. They're probably keeping an eye on the cost side of things some, and are making sure that the home purchase isn't going to bankrupt them. But when it comes down to it, these people's first priority is finding a home that they love, and as long as they can afford it on paper, they're going to want it. They know they're planning to be in the home for a long period of time, perhaps the home they want to raise their kids in, and aren't concerned with things like cash flow or what the property could rent out for if it was a rental. All they want is a home that they can call their own and a place that they can make money from in the form of equity gained over a long period of time. This is very different than a person who is purchasing the home as an investment property and is wanting to maximize the financial side of things from the property. These investors are much more concerned with the price of the property and, more importantly, the rental market in the area, because they know that they are most likely going to be renting it out. Maybe they plan to live in the property for the first couple years, but they want to buy something that they know they could turn into a profitable rental property within their near future. There are a lot of reasons to buy real estate, and each home buyer has different goals and plans for their real estate and what they want it to offer them. For the people looking to buy a home for their personal residence, something that they can live in for years and want to turn into a place that they can call home, this is where you are going to see a lot lower down payments, and where, frankly, I am much more comfortable with people putting down lower down payments. In these cases, the most important thing to look at is the percentage of your household income that the mortgage payment will cost you. Since you're going to be the one paying the mortgage and making the house payment, you need to make sure that this fits into your budget without stretching you at the end of each month. You do this by figuring out how much your payment will be if you put down, say, 5%, 10%, or the minimum 3.5%, and determining how much of your take-home pay it will cost you each and every month. A good rule of thumb is to only purchase a property that will take less than 30% of your take-home pay to afford. Now, there are a lot of experts out there who are going to share other percentages. I know Dave Ramsey says you shouldn't spend more than 25% of your take-home pay on housing costs. Other experts say it's okay to go up to like 35%. I put 30% kind of as a medium ground, but the important thing is to do whatever you're comfortable with. Don't let it go above that percentage. You can determine how much your payment will be from a particular property by visiting mortgagecalculator.org, and I have other videos on the channel that show you how to use these property calculators to determine your payments and expenses. Now, if you're looking at this property from an investment standpoint and are wanting to buy something either as a rental property or perhaps as a primary residence that can be transitioned into a rental property down the road, this is where you need to do some more careful investigating. You need to be aware of the rental market in the area so you know how much you will be able to rent it out for when you purchase the property. You then need to calculate how much your payments will be should you put down a certain percentage, and of course the rental rate needs to exceed your payments and all other expenses to operate the property. Now, if you're planning on living in the house first, then you may have a little wiggle room since rental rates do tend to go up in most areas over time, and if you're planning on living in the house for a few years first, then chances are the rental rates will go up over that period of time. But it's best to go into that home purchase knowing how much you'll be able to rent it out for at that time, or perhaps in the very near future, and make sure you are putting in an offer on the property that actually matches up. In these investment cases, it's typically recommended that you put more down as a down payment because the larger your down payment, the lower your mortgage payments will be. And when looking at a property from an investment standpoint, having lower payments means higher cash flow and more money for you each month. With that being said, most people probably don't have 20% of the down payment saved up for a home. They're thinking more along the lines of putting 5 or maybe 10% down, but still want to look at it from an investment standpoint. Should you wait to buy until you have 20% saved up? The short answer is no, but again, everybody's needs and comfort levels are different. Getting into a property is a big decision, and you want to make sure that you are making the right one. So again, look at the numbers, figure out what your payments would be if you put down a low down payment, and see if it matches up what you can charge in rent. If you find something that would rent out for more than the amount of your mortgage payments, even while putting down a small down payment, then that's a smart move. Chances are you can live in that unit for a few years, and by the time you're ready to move, the rental rates will have increased in that neighborhood, and you could rent it out as a high cash flowing rental property. The issue comes when people are trying to rush into buying a property. They put down as little money as possible with the hopes of turning it into a rental property, but they purchase the property at too high of a price, and their mortgage payments are now higher than what they can rent it out for, and this is a situation that you do not want to be in. The solution is to simply take your time and surround yourself with experts, a good realtor who knows investment properties, a property manager that can forecast future markets for you, perhaps a good lender that can give you the best rates, all those types of people. These are the people that should guide you into making offers and attempting to purchase properties that will be smart financial investments for you down the road. Now, as I wrap things up here, I want to reiterate that there is nothing wrong with getting into real estate with little money down. Countless real estate millionaires got their start by taking a chance on a property with little money to back them up. The key is finding deals and putting that little money that you do have into properties that will actually be cash cows for you in the future, or at the very least, allow you to cash in on in the form of appreciation when you do decide to sell. So that's it, you guys. Thank you so much for watching this video. If you enjoyed the content and found it helpful, go ahead and hit the like button down below. It really helps me as I'm trying to grow this channel and expand my audience. And hit that subscribe button if you want to join the community. And any comments, questions, or suggestions for future video ideas, go ahead and drop that down in the comments section down below. I'd love to get the conversation started, and I will see you in the next video. Thank you so much and have a great day.